In this video, the complete framework of how to invest and make money with cryptocurrency. I'm going to go through all of the different methods, how they actually work, and then the risk that you're taking with each of them so that you can decide how much risk you want to take with your portfolio and if the methods are actually right for you. I'll leave timestamps for each of the methods down in the description. Most of the time, the main method that people use to invest is dollar cost averaging, or DCA. This is where you choose one or a group of investments or a group of assets and just add to them over time. So if you've got an investment plan or anything like that, you choose the assets that you want to gain exposure to and you just invest over the long term. So this is only really good for a long-term strategy. And what I mean by long term is at least 10 years. So I wouldn't expect to be making any money or even try to call back the assets that I've invested for at least 10 years. Now, this means that you can invest through economic cycles. And so you're buying assets when they are depressed in price and assets when they are more expensive as well. Obviously, the point of investing is to buy as low as possible, which can be extremely painful, especially in a bear market and in a recession. But they are obviously typically the best times to invest, given that you're actually investing in assets that are going to grow over time. This is a passive investment. And so really you are choosing the asset classes that you want to invest in and then giving a percentage of your investment to them, right? So if you have a mortgage that you're paying off, that is a payment and an investment in real estate. If you have a 401k or an ISA or something and you're investing in stocks, that percentage is your exposure to stocks. And then you might want to choose Bitcoin and a couple of other altcoins to get investment into a growth technology and a growth space. So you can choose that yourself. How to actually invest. It's very simple most of the time with crypto. I'm going to show you my Binance right here because you can dollar cost average. As you can see, if you dollar cost average Bitcoin or all of these coins over the last year, you would be down. This is obviously terrible, but this is investing. It's a risk where you have to put your money at stake and invest your money over the long term to take advantage of falling prices and then years later take advantage, hopefully, of fundamental growth within an industry. As we can see here, Bitcoin has fallen 35%. So you'd be 35% down if you dollar cost average Bitcoin over the last year. But if you would have bought in at the top at 50 or 60,000, you'd be 70% down as of making this video. Now, most people can't handle that. They can't handle the volatility. And so, if you are someone that can handle the volatility, then dollar cost averaging gets you better prices during the bear market. But please come in with your eyes open when you're investing in a growth industry that volatility is extreme and a lot of people can't handle sitting on losses like this. But with dollar cost averaging, all you do is create a plan. You put some dollars in your account. If you put some dollars or pounds, whatever, it goes straight into BUSD. You can put the BUSD there, and then you can say, I want to buy weekly $20 or whatever it is, $200 on a Monday at 1 a.m. and it's just going to tick over. You can do that on Binance, you can do that on other exchanges, and you can just do it yourself as well each week where you just log in and buy some and then take it out to a wallet that you own. And that is dollar cost averaging. But like I said, at least 10 years as an investment time horizon. I'll leave a link to Binance in the description. They give a deposit and trading bonus. So if you're doing that sort of thing anyway, might as well take advantage. Also, I'll leave the crypto investor course link there. There's 2 sections on investing and portfolio management, which can help a lot of people out when putting together a portfolio. So I'll leave all that down in the description. But what I want to talk about is after dollar cost averaging is actually how to value blockchains. If you're buying garbage over and over again and dollar cost averaging into stuff that's just going to be completely useless, no one's going to use it in the future, then obviously that's not good. Dollar cost averaging works when you're investing in something that's growing over time. And so for me, this is a very simple valuation technique that I use for blockchains to have more confidence in actually buying something. So the first thing is users, right? Like users is the main thing. You have to see users growing over time. The more people that use something over time and the network grows, that's typically going to, over the long term, give more value to it. Value transferred per transaction is really important, meaning for every single transaction, how big is the average amount of money that's transferred? What we can see is that the blockchain that has the highest value per transfer is actually valued the most, and that's Bitcoin. It has more than anything else, right? Does it charge fees? And do those fees accrue back to you as an investor? For Bitcoin, no. For everything else, most of it, yes. And so that's actually very, very different, right? Because Bitcoin is supposed to be money, and so it shouldn't charge fees. You shouldn't be able to invest and actually get returns from it because it's decentralized store of value. Other types of platform or applications are more like a business and so can charge fees and maybe give you investment returns back. The next one is neutrality. Bitcoin is the most neutral settlement layer in the whole world. It's unco-optable, and that means it probably will have more value than something that is owned by like 5 people and they can stop it or start it or, change the money or anything like that, right? So putting all of these together, what we get is Bitcoin is essentially should be the most valuable. It's the most neutral. The most amount of value is transferred, and it has around 200 million users, give or take, depending on how you look at it. The next way people want to make money with crypto is investing in small altcoins that they think are low valued that can rise up very quickly. But obviously there's a ton of risk here. So now we're getting into investing in money over the long term to basically a business that's extremely volatile and risky. And so, yes, there are opportunities to make money. Yes, there is much more risk with this. So how to actually evaluate these applications? What I'm talking about here is the applications built on blockchains. So you have money, which is Bitcoin. You have platforms, which is Ethereum down, smart contract platforms. This is my valuation framework of crypto. And then you have applications or businesses built on top of those blockchains. Uniswap is an exchange where people go, they exchange tokens and they pay a fee. They don't actually charge a fee right now, but I won't get into that in this video. So, this is a business. Just like any business, we can value this on how much do you charge your customers and how much of those charges and fees do you pass back to me as an investor? So first thing, how many users do you have or plan to have? What's the growth of those users? Secondly, how much do you charge? How much money do you make? Because then I can put a valuation on that. So I think of Uniswap just like Airbnb or Uber, right? It's an application where you have 2 different people that come together, do something, get charged a fee, and then leave. And so we can actually put a valuation on these very simply, right? These are businesses, simple, plain and simple, right? They operate on a blockchain, but they're a business. An exchange is a business, and so very risky. And the total valuation is capped to how much money that they can actually extract from users over the long term, right? Very, very different to Bitcoin and money. So what we can actually look at here is, well, how much money do you make? So what we're going to do is look at something like Token Terminal. It's like one of the best websites in crypto, shows you all of the fundamental data. Ethereum is the most successful business in cryptocurrency. It makes the most money. Uniswap is the second most successful business because it charged people a fee. Actually, all those fees go to liquidity providers, but I won't get into that. Lido Finance, PancakeSwap, these are exchanges. They charge a fee to people. So we can put a valuation on them. So for example, Lido Finance, this is a business. It's an application. It's a business. They provide infrastructure and they provide validators and they take a fee for the service that they provide. So what we can see here is that the fees over 30 days is 30 million that they've earned. Now they give 90% of that away to the people that are actually putting Ethereum with them, which I won't get into, but essentially they skim off the top around 10%. So you can see their revenue over the last 30 days is around 3 million. Now their 12-month revenue is 38 million. So we're just going to put 38 million in here. Now you can put a valuation on this that if they earn 38 million a year and that revenue goes towards the Lido DAO, that DAO is essentially a company and you can own the tokens, which is owning a share of the company. So this is the modern version of a company. And if it earns 38 million a year, you can put a multiple on that of, for a growth company, let's say 25 times. And so you're looking at a valuation here for the Lido token of around $1 billion. So what you can do is now go over to CoinGecko and look and see how much Lido is actually valued for. It's valued right now around $800 million. Do you think that is over or undervalued given the future? So that is a very simple valuation metric that you can use to actually value blockchain businesses. The problem is they're extremely risky. We don't know how many are going to get regulated out of existence or shut down for not being compliant with securities laws. You're investing here in equities in the Wild West. Very risky, but a potential to have really good growth and getting some fairly good deals, but you need to be an investor to do this. The next thing people will try and do to make money from their crypto portfolios is to earn yield on it. Now, there's obviously pros and cons here. Earning yield means doing other things that could potentially change the risk profile of your portfolio. And we've seen, during this bear market, lenders have had an absolute nightmare and your money goes to zero because they go insolvent. And so let's talk about the pros and cons here. Compounding is a real thing. Compounding interest And compounding yield is a real thing. And it's part of the reason why the stock market yields 8 to 10% per year is because of the dividends being compounded back. So it's a real thing and it makes real money. There's obviously risks here. So CeFi lending for the most part is completely dead. We're talking about Celsius and BlockFi and Gemini, with everything's gone, belly up basically. So let's use crypto for what it's for, which is decentralized, lending or decentralized finance. So we're not going to put any crypto with CeFi lenders because even though they may pay 10% yield, what you're doing is taking an apex asset like BTC and turning it into a junk bond. That's how you get the 10% yield. And, the insolvencies mean that it's all gone, right? So let's not do that. So let's look at DeFi lending and see what the risks are here. DeFi uses smart contracts. That means you put an asset onto the decentralized platform, and the smart contract dictates the terms that you get. You keep control of your assets. They're on the blockchain. You keep control of them. You keep custody of them. And you may lend them out to someone, but they do it on a over-collateralized basis, meaning let's say they want to borrow $100,000 of a stable coin because they're a market maker and they need some short-term liquidity. Maybe they've seen an opportunity that they can make an arbitrage in the market and they need some dollars. They'll take some Ethereum or wrapped Bitcoin, some other asset they have. They'll put $150,000 of that onto the platform and they will borrow $100,000 of the stablecoin. Platforms like Aave only allow over-collateralized lending, meaning that the lender or the borrower has to put more assets on there than they are allowed to borrow. Therefore, if the price of those assets goes down, the system will automatically trade them out. Now, these have been running for years, and for the most part, they've done so without a hitch. There are a few issues here and there, and so let's talk about the risks. The risks are smart contract risks. If you're using smaller platforms, those smart contracts can have bugs, and as has happened many times in the past, someone hacks it, all the money's gone. It's a big risk and probably not worth the extra 0.5% that you're getting on your asset. Platform risk generally, there are occasions where there are bad debts within a DeFi protocol, and those bad debts have to be paid off, and that comes out of the protocol's token, in this case Aave. For the most part, that's not a massive deal for most people, but it is a risk. The other one is just simply a rug pull risk. If you're using anything that isn't a very, very top-end DeFi protocol, then the protocol can get rugged, a scam, an inside scam, all the money's gone. That is real. And so is it worth it? For most people, maybe not. As you can see here, what you can do with Bitcoin is turn your Bitcoin into wrapped Bitcoin. And you can see what the real yield you should be getting is 0.5%, right? 0.58%. Why? Because the person has to put more assets on the platform that they're borrowing. So Bitcoin, there's not much use for that on Ethereum, so the interest is very low. Now for stablecoins, you can get at the moment around 3%. Again, it's not a lot, but that is commensurate to the risk you're taking. If you want to get 10 or 15%, welcome to take much more risk, basically junk bond risk, or if you want less risk, you have to get a lower yield. Also, when it comes to wrapped Bitcoin, what you're doing here is taking Bitcoin off of the Bitcoin blockchain. You're using a centralized counterparty called BitGo, who actually have and hold that Bitcoin for you. They're creating wrapped Bitcoin on Ethereum, which is a one-for-one. And so you have more counterparty risk here. You have BitGo, are they going to do anything? Are they going to blow up? Are they going to get hacked? Whatever. There's counterparty risk all the time. And so you can decide whether this yield is actually appropriate for you, given the amount of risks that you're taking with counterparty risk, platform risk, smart contract risk. But that is a way that people use to, just get interest on stable coins or other crypto assets. The next method people will use is staking, and that's different to lending. Lending has counterparty risks. Staking is something that proof of stake cryptos give you. Like I said, Bitcoin is a decentralized commodity. It is money itself, and money itself does not pay any yield. Now you can use Bitcoin, you can wrap it, you can lend it out, lending pays yield, but then you have that counterparty risk. With platforms like Ethereum DAO, smart contract platforms, these charge fees, and if you invest in the coin, some of those fees can get passed back to you and accrue value. Now, here's how I would do that. Staking is actually a punishment for the most part for most networks. I'll explain that now. Apart from Ethereum and BNB coin, Every other network still pays staking rewards from the emission of new coins. What that means is, I'll just show something with a lot of coins such as Avalanche. What we can see is that the circulating supply of Avalanche is 310.5 million, but the max supply is 720 million. So not even half of the total supply of Avalanche coins are in existence. That means that every time that you're paid a staking reward, the staking reward comes from the creation of new coins, right? They're dipping into this supply that isn't currently out in existence and isn't currently circulating. And they're taking that new supply, creating a new coin out of nowhere and giving it to you. As we can see here, the market cap of Avalanche is 4 billion, but if you were to have all of this max supply out in existence, that would actually create a valuation of 9.5 billion. So what we're saying is, when we're buying Avalanche right now, even though we think, wow, it's worth 4 billion, that can go up really quick. We're actually investing in something that is going to be diluted by 50% by the time all of the coins are created. So all of that staking reward that you're getting, wow, I'm making passive income, I'm getting 5% yield. No, you're not. That is not yield. Any staking reward that is paid from the creation of new money is called inflation, and it's not good. That's why the dollar has lost 90% of its value since the Fed was created, because they keep creating more of them. That's the whole point. And so really simple is, if a blockchain actually makes money and doesn't create any new coins, then you can get 2% or 5%, and that is actually called real yield. It's like a company paying you a dividend that is actually a real yield. So what we can do here is say which coins at the current time actually pay real yield, meaning they don't have any more coins left and they are paying interest, or they're paying a dividend from the fees that they earn. Ethereum and BNB coin. That's it. All of the rest are still producing coins out of thin air in order to give out to people. So we can just have that as a framework. Now, what we really need to do is say, at what point are they going to stop? Like, how much of the supply is left to go? Are they going to stop? Some coins will never stop. Dogecoin will never stop producing coins. Its inflation is 2% per year for the rest of time. Some coins will stop. Cardano will stop. It has a hard cap. Polygon has a hard cap. BNB coin has a hard cap. So when we're looking at yield, what we're looking at is, you can do all of this research. I'll leave links to everything in the description, all resources. How much token supply is left? If there's a lot, then that's going to be a weight on the price, and that's not staking income. That's not staking yield. That's just, you're actually getting a worse deal. You need to be invested in coins that make profits. So it's a profitable protocol that pays you some of those yields. So that's real yield. So when you're staking, what I would say is, do not choose a coin based on its staking rewards. The higher the staking rewards, the worse it is. There should be a small yield because of competition driving down all of the prices and yields over time. So any crypto that you're looking at, actually you would just buy it first because it's a profitable protocol that has users that are growing over time, and it's actually a useful protocol that is being used. If it pays staking rewards, that's great. If it pays a very high staking reward, it's probably from the creation of new coins, which is a bad thing. So I would never ever choose a cryptocurrency based on its staking rewards. I would choose one that's profitable and actually growing over time. And staking rewards are a bonus if they're actually real yield. The next use case of crypto is to earn LP income, which is where you actually have assets and you provide them as liquidity on an exchange, and the fees paid on the exchange, half of that comes back to you as a liquidity provider. This is actually one of the main use cases of blockchain technology, in my opinion, where it actually gives power to the people. The people that own the liquidity can earn some of the LP income or the trading fees from lending and borrowing and trading and everything like that. So this is how it works. You take something like a stable coin, or you can have other types of assets. Now what you can do is lend them, and we've seen that, right? You can lend them out, which is fairly straightforward, or you can LP them, and I'll show you that now. So the way that you LP, I'll just use Beefy as an example here. This is a yield aggregator. So what it does is it puts together lots of liquidity pools from around different DeFi protocols, and then it earns a yield from the trading fees and passes that back to you. So I'm not promoting Beefy or any other type of exchange or protocol here. This is just how it works. So what users will do is they'll go over to something like stablecoins, and they will see what yields stablecoins are getting right now. So as an example here, what we can see is PancakeSwap. This is a decentralized exchange on the Binance Smart Chain. It's one of the most used decentralized exchanges out there in terms of the amount of users. I think is actually number one, but Uniswap does more volume per transaction, and so it's worth more in the market. So for this, you have US dollar Tether and US dollar coin. These are two types of stablecoin, dollar-backed stablecoins. People often want to trade one for the other because they need it for whatever, or they need to put USDC somewhere or whatever. So they trade one for the other, and they get charged a transaction fee for doing that. Now, if you provide liquidity to this exchange, and so you have both of these tokens and you provide liquidity, you can take some of those fees. And right now you're earning 5.35%. Now that's a decent yield on dollars. If you invest that in US treasuries or something like that, you'll be getting 3.5%, 4.5% as of making this video, probably lower in the future. And so that is a way that someone can earn yield on dollars, right? They're providing liquidity and they earn yield on dollars. I've got tutorials and how-to guides on all of these platforms, but I don't want to promote them or say they're a good thing. There are, of course, risks with all of this, but this is a way that people use stablecoins. They provide liquidity and they earn a yield on them. What are the risks? Smart contract risks. Whenever you're using an exchange, the smart contract can have a bug and it can get hacked. This has often happened before. Rug pulls from the exchange. If you're not using one of the top exchanges, the rug pull risk is pretty high in my opinion. You also have pool and asset risk. Like, there are stable coins here that I would never touch with a barge pole because stable coins often lose their peg. They're backed up with rubbish assets that shouldn't be backing a stablecoin. There are so many risks here and there are so many assets you think, what even is that? And so massive risks here, right? Just because something calls itself a stablecoin doesn't mean it's stable. And so there are massive risks. And again, you need to be an investor. You need to be highly educated and knowledgeable about all of these different assets and platforms to do this. And so is 5% that's currently being made actually worth the risk? I guess that's up to each individual investor, but this is another way of actually LPing, or providing liquidity, is a way that people use crypto to earn yield. The highest risk to reward ratio in crypto and in investing in general is trading or speculating on prices. A lot of people try this, so let's go through the risk and reward here. This for me is the most terrible risk reward ratio for most people. Trading is extremely difficult, but obviously the potential rewards are very high, but probably not commensurate with the risk. There are ways to mitigate your risk when trading, and I'll go through some of the methods that professionals may use to actually make money out of the market here. So again, you need to be an investor and you need to understand the markets. So let's go over some ways to actually trade, right? So people often use futures to trade, which is on a platform like BitGet, where you can trade futures. Now, futures are a way to trade very easily because you can actually take long positions, which is where you benefit from the price going up, and you can take a short position, which is where you benefit from the price going down. Now, this is not investing, this is trading and speculating on prices, and so futures are good for that. But for most people, I would say this should be a very small part of the portfolio and risk should be managed. The reason why I mention it is a lot of people obviously like to feel like they can speculate on prices and they know where the prices are going to go, and they can make money short term. Now, one of the best ways that a lot of crypto traders make money is actually just basically shorting a lot of projects that have failed or have quite clearly not going to accrue value to the token. This is actually something that's specific to cryptocurrency that most retail investors can't do in any other market. And that is essentially short projects. Shorting is where you take a trade where you are going to benefit from the price going down. Now, when you use futures, you don't actually need the asset to sell. You can just take a short position. And so, you open a sell order first and then you buy back when it comes lower. The reason why I say this is because during bull markets, everything is going up and you can take long positions and that's great. During bear markets, traders will actually flip to the sell side and go short. Now, with crypto, most projects are going to fail. And also, as I talked about circulating supply, as you can see, most projects, you'll see that they have this massive supply of tokens. And when they initially launch, they launch it with a very small percentage of that supply. And over time, the supply unlocks and gets bigger. And it's just like a continuous dump of tokens on the market. Now, when you have the same or lower demand and more tokens, what's going to happen to the price? And so just some examples here, Steppen during the bull market, massive speculative bubble. And then during the bear market, you have this slow, steady, just drip down where tokens are getting unlocked. People realize that they don't want the token, they sell out. The realization that there aren't any users or any use case for this token, it just drips out over and over the long term. So something like Steppen, as you can see here. Another one is Decentraland. It's quite clear at this point this is utterly useless. And you had a big, bubble here, and then just the slow drip down, drip of tokens over time. And you can see that the total supply is 2 billion. Most of that is in existence now, but who is using this project, right? Not many people. And so this is what happens during bear markets. So trading, is extremely dangerous for most people and probably not recommended for most people. But this is another way where people actually make money, is not just investing and going long projects. The probability is that most projects will fail. And so when investing or trading, you just play the odds. Most are going to go down. And so people will short, and benefit from falling prices. Now, trading is extremely dangerous because what you get with cryptos is you get these kind of very short, sharp rallies, as you can see here, which can wipe you out completely. And so I wouldn't recommend trading for most people, and using leverage is not recommended for most people either. But it is a way that people will try and make money with cryptocurrency. Terrible for most people. You do need to mitigate your risks extensively, and you need to manage the portfolio as well. I've got some videos on trading and how to manage portfolios and how to manage trades, so I'll leave them in the description as well. The absolute key to crypto, in my opinion, is taking control of your assets. And so this is the best way to not get completely wrecked. We've seen during this bear market is that a lot of people did all the right things. They dollar cost average, they invested, they took some good trades, and they got completely wrecked because their assets were on a centralized exchange. The whole reason that Bitcoin exists and crypto exists is that you can take the value of your money and you can take it out into your own custody. So I'd recommend using a wallet like Ledger. I use Ledger. Ledger or Trezor are great, linked in the description as well. These can be, paid for, like the hardware wallets like these, but you can also get free wallets as well. They're a little bit less secure. You need to know what you're doing. Videos in the description for that. But the whole point of crypto is that you take control of your assets. And so you're taking away that counterparty risk, but you still have trade and position risk as well. But often the best way to actually make money is over the long term, just to not get wrecked. And so we've definitely found that out in this bear market. More info on everything I'll leave down in the description. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.